Hello and welcome to Unleashed, show that explores how to thrive as an independent professional. I'm your host, Will Bachman, and I'm pleased to be here today with JJ Casper, who is a McKinsey alum and the founder of a venture capital firm, Blue Collective. JJ, welcome to the show.
All right, thank you.
So JJ, of course, we want to explore your journey and understand some of your, about what your firm does, the type of investments you make. But first, I wanted to ask you some quick rapid fire questions to help us build a primer about venture capital. So some quick questions here. You can just give a 2 or 3 sentence response.
All right.
All right. So what's the difference between VC and private equity?
Technically, venture capital is private equity. If you wanted to, have the dictionary definition, it is private equity. The way that people use it, though, colloquially, the difference is venture capital is always minority positions, and private equity typically, although not always, is going to be control positions or on a path to control, and bigger chunks than venture capital investors would take.
So private equity would be the umbrella term, just meaning it's a privately owned company as opposed to a publicly owned company, and it's investors being as opposed to just the founder owning the company.
Right. And if you wanted to get really pedantic, you'd say it's the asset you're buying is in the private market, but yes. Yeah.
Okay. In terms of some people will talk about different aspects of the private equity market, like, the lower mid-market, the mid-market. So it sounds like there's a spectrum, and VC is one of those slices. Is that fair to say?
Yeah, and I would say these relative to the designations of like lower mid-market, and everyone defines those very differently. Those would typically be used to break apart the private equity, and I'm using it in the sort of the way we typically say private equity versus VC. And so VC, though, is a piece of private equity that is really reserved for companies from inception to some sort of exit event that are growing extremely, extremely fast. And the only reason I'm saying that is because the mid-market thing is more referring to the size of the company, whereas venture capital is sort of a carve out for, in essence, almost the stage of the company and the quality of the growth.
How do venture capitalists make money?
Oh God, we don't for a very long time, at least when you start a firm like me. But then where you do make money over time is the same way folks in the private equity world make money, is you make money through management fees that your investors pay you to do your job, and then you get paid also on the success of your decisions, your investment decisions in carry when companies exit and return investment profits.
Okay, so it's not just the exit price of the asset when you sell it, but you also do get a percentage of the assets under management, if you will, or the
Correct.
fees.
That's right. That's the typical model, and I would tell you, as maybe a philosophical or personal, I think the model is fantastic, so long as it's working correctly. And I think we certainly are, but I think that private equity folks, venture capitalists, should be most incentivized by the carry, the profits on the back end. I think, and frankly, investors into these funds should demand that. What happens often, though, with bigger firms is that dynamic gets flipped, right? You reach a certain AUM where you are making more money than God would know what to do with from the management fee. And that, of course, I think takes your mind off of the success fee, right?
And what's the typical management fee percentage? Is it 2% or some other number?
Yep. It's still the same. There's probably more variety in venture capital than the broader private equity world. In both directions. So you'll see sometimes early firms that'll have a lower management fee, because they're trying to attract investors. Then again, actually, if you're like us, we actually have a higher management fee, although it's all front loaded because we look at it as we are a very small firm. and we pay ourselves a pittance, and we want to make sure we do a good job, and then we actually taper off our management fee. But there's a bit more variety in venture capital. I would say you see anywhere from 1.5 to 2.5 more often, and then private equity tends to be a little bit more centered around 2.
Sebastian Mallaby has a fantastic new book, The Power Law, which came out earlier this year, on the history of venture capital. Other than The Power Law, are there any other books on venture capital, the history of it, the greatest players, any other books that you recommend on the industry?
There is actually, and I would say maybe as a side note, I've only been a practitioner in this industry for 7 years. I have some issues with the Mallaby assessment, maybe more around the implications, but a great book, although it's quite dry and boring, but is VC, An American History. It's the only book I would actually recommend in VC. It's by a guy named Tom Nicholas. I think he's a Harvard guy. I'm not entirely sure. That's not reason to recommend it, but it's actually about, the thesis is that venture capital and private equity grew up out of the whaling industry in the 1700s. And what's interesting about it, and you can, agree or disagree or not care at all, but what's interesting though is he actually has transcripts / photos of the original contractual agreements from the whaling times, and it is, strangely enough, it's very close to the 2 and 20 model. They got paid a management fee that equated to something that sort of would approximate that 2%, and they got paid a success fee that was about 20% on the profits that came back from whaling ships. And if you were a whaler, you would send out 100 ships. I might have the numbers wrong. 100 ships in a year. You expected 20 of them to return with people alive. You expected 10 of those to actually have caught a giant whale where you made a ton of money. So actually, even from the sort of investor side, the model was the same. It was a portfolio model where you expected a large number of losses. And of course, with whaling, it's like dead bodies, et cetera. But it's a really interesting, you wouldn't think that's very interesting, but he really gets into it. So I would recommend that book if you're just interested in the history of this.
That is good for the whaling investors, not so good for the whalers. But
yes.
I have heard that comparison before of the whaling industry, which is pretty cool. How do venture capitalists compete with one another to get access to deals? Because you're obviously investing in the companies and competing to find companies, but you're also competing to be accepted, right?
Yes. I would make a distinction here. I would say the modes of competition or how firms compete, I would say, is very different between really early stage venture capital firms like us, so meaning like day 0 to year 2, versus the later stage folks, the folks that you will typically be seeing in the newspapers and stuff like the Andreessens and the Sequoias, et cetera. I'd say the model, how they compete, is actually quite different. In the later stage side, which tends to be what is mind share for most people in the industry and what you see in the newspapers, I would say, and I'll add the adjective here, unfortunately, I think it's become a lot like the A&R business in the records industry, in that it comes down to a lot of which firm has sort of the biggest megaphone and can hype up their founders and companies so that they can get the next set of investors interested, and also who's got the biggest wallet, right? So you can continue to fund where a company sort of misses a step, or otherwise you can actually fund and paper over the next round, and so on and so forth. So there's been this, because of that too, there's been this, well, for a lot of reasons, there's been this real, you can see it where the firms that say only like 10 years ago might have had 200, 300, 400 under management now are approaching 1, 5, 10 billion, 20, Andreessen's now 23 billion or something under management, these crazy numbers. So it's a big platform play. Where we compete, it's very different. It's one reason why we like early stage, really, really early stage. I mean, we invest often, most of our companies we invest in are pre-revenue. We like it because at the end of the day, it just comes down to your network, like who you know and who you're getting to know, and the in the early days too, I'd say the quote expertise you can bring to bear. But in the early days, the expertise is really just expertise about building a company in the early days. It's not a industry expertise is less important in the early days than network connections and understanding what that early journey looks like. So whether you're a cowboy boots company like we've got, or a bio 3D printing company, the first 2 years of both those companies look pretty similar. Right? Like the founder, what they were going through was super, super similar. And what we bring to bear is we've been through that before ourselves, and now we've seen it, 100 plus times. And so we can at least help to guide a little bit and coach, like, don't do this, do this, so on and so forth.
So the larger sort of later stage firms, they're competing on the megaphone or how much publicity they
Platform
can provide.
and brand. Platform and brand. Yep.
And when you say platform, in addition to the PR, I imagine there's also being able to provide, services or advice on helping find talent or counsel from seasoned veterans or.
Yep. I'll give you a hot take here. I don't know if anyone in your audience is, will have the perspective to disagree with us. They do. I'm happy to have a chat about it and be corrected too. But I'll give you my hot take is, so yes, by platform, it does mean that. I also just mean a bunch of capital, right? Like a bigger wallet, so you can fund a bigger and bigger round. But the piece that is what often gets called in our industry value add is a lot. It's in many ways also for the VCs. It's a copy of what the private equity folks have done forever, right? And I said earlier, I sort of define private equity as either as sort of a big stake / a control stake, right? You have more control over the company, more ownership, and therefore more influence. And so the VCs have copied that. And my hot take is I actually think most of that is irrelevant and a waste of money. And I don't say that because I'm sitting here at early stage and I don't deal with it. I say that because when I talk to our entrepreneurs that are now later stage and have raised from big firms, they don't give a stitch for that stuff, right? Like great entrepreneurs do not need that. They will figure out. In fact, I remember chatting with one of our guys who's got a 250 million revenue company after 5 years, and he's living high on the hog. He's got a great business. And he's got an investor that does a bunch of this value add stuff, like forums and playbooks and et cetera, et cetera. And I said to him something like, did you go to that CEO forum or this or that? And he said, what? I didn't know that was happening. I don't have time for that shit. So a lot of that actually comes from big institutional LPs. So it's very bizarre. Is there's a weird part of the business model in DC that's almost been transplanted and forced on VCs, but if you got a big wallet, you just say, let's sort of cater to that and do it. I'm not sure the entrepreneurs really care. I'm not saying that it isn't helpful in certain places. There are probably folks that do it very well. I think in general, though, it's just a waste of time, and it's a vanity metric for talking to LPs.
Walk me through these different stages of investment, like what they mean in practice. So angel, pre-seed, seed, series A, et cetera. I'm probably missing some. What are the, walk me through these different stages.
Yeah. And I'll give you sort of maybe it's my definition, but sort of the classical definition. Once you realize when you're in this world is people often, change the terms and use what they want. But, and the best way to think about this also too is not so much in terms of the name of the round, but actually the stage of the company, right? That's more determinative than is it a seed round. And so when you first start your company, you got to fund it somehow. And a lot of great entrepreneurs actually do fund it on credit cards, right? Or with some sort of, personal savings or otherwise. And frankly, we actually like that as investors, seeing that they did it and put some money at risk. But that first round is usually called the angel round or the friends and family round. And that's typically happening pre-product. So pre-launch, pre-product, pre-MVP, whatever you want to call it, right? So that's where it's, a founder or two founders, a pitch deck, and a dog. And I always tell people too, because you hear from entrepreneurs a lot of times, I don't have friends and family that have wealth. And I always say, I think it's, for what I don't either. I always say, I think it's more a metaphor, right? Like that first round, 99% of the investment's in you, right? It says they trust you. That's why it's friends and family, right? Because your friends and family hopefully trust you, but there are other people that do too. So anyway, that's the first one. That's usually pre-product. Then you got a product, and you are beta testing it. You're making it better. You're getting ready to get into monetizing whatever that product is. That's where you typically raise what gets called now a pre-seed round. So that's sort of that next stage. Now that's also where sometimes, but not always, institutional investors like myself, so like people that do VC as a job, start to get involved. Whereas that first one, that's why it's called angel, friends, and family, usually is individuals. Then your seed round that's typically where, and this has changed over the last few years too, but I'd say seed is then typically where you're actually in market, you've got a little bit of data, a little bit of traction, you can actually show how things are going in terms of numbers, and that's going to be your seed round. And what happens in it, and the one after that then is called the Series A, and that's the big one, kind of always has been historically, where it's like where a boy becomes a man or a girl becomes a woman. Like that's the big one, and that one is the term that it's used in this industry, which always confused me in the early days, but I sort of get it now. Is what's called product market fit, right? So you've demonstrated at that point, or let's hope you have. The investors have determined that you've demonstrated that there is a significant segment of people or businesses, whomever, willing to pay for your product, right? That's the one too where people say, I'm going to throw some fuel on the fire or whatever, all those metaphors. And so after that, then B, C, D, E, that's all just scaling. With one thing that's gotten missed over the years, like if you go back to what VCs used to write 10 years ago, and this wasn't like all the blogosphere stuff today, but like people actually wrote in letters to their investors or otherwise, or how folks in the old days, so to speak, thought about investing. One thing that's gotten missed though is actually Series B and beyond also was often about starting to craft a path to profitability. That's gotten lost a little bit in the last, say, 5 to 10 years of VC here in the States. But that's how it's set up. And so sometimes you might see a Series F, a Series G, and that's just a company continuing to raise in the private markets as they scale the thing that they do.
Roughly, is there thumb rules around kind of how much money we're talking about at each stage?
Yep, which also shifts over time. So as I said, only been doing this 7 years, but I'd tell you this has shifted tremendously even in my time. But so I'd say the angel, friends and family, if there is one, sometimes there's not, but it's usually going to be, let's call it 250 to 500K. That pre-seed round now is going to be anywhere from 500K to maybe at the high end, 1.5 million. The seed round is going to probably be 2 to 4. And then that A round, there's less, I'd say there's more variability there, but that may be 10 million plus, 10 to 20 to maybe as much as 30 million. And the rounds after that can get ginormously bigger, but that's based more on category and business need, et cetera.
And how does it normally work at, call it the pre-seed round, where you might start to get involved, or the seed round? Mm-hmm. Is that like one investor, or is those typically multiple investors coming together?
Multiple, and so I'd say typically multiple. It should be multiple. That's the best answer for the entrepreneur and for the investor. I would, and go as far as to say we have made that mistake in our past of taking a bigger chunk of an early round than we should have, and it's a bad decision. And so it's actually at this point now, for us to invest, it's, we might have the biggest check in the round, but we need some other people at the table. And that's, as I said, we think that's important for the entrepreneur, for the business. Like, they need to hear different points of view, not just from us. And they need to also demonstrate that they can raise from folks other than just us and start building relationships. So that's, but those early rounds, typically it's you call it a party round in private equity, but that's the ideal round. As you get later stage, it also still is like a bunch of different people. But at that point, though, you find the lead investor in each round, which is going to be the investor that is typically writing the biggest check and also setting the terms for the round. You'll typically find in later stage, so A, B, C, so on and so forth, that there is one or two really big investors that are going to take 90% of the round or something like that.
So what's the minimum investment for a VC fund typically? And we can talk about an early stage fund like yours.
I would say it's a huge range, and it more than anything else, this depends on the size of the fund you're deploying, right? And so within that, that's what I mean to say by that is, and it differs by stage too, right? So if you're participating at A, B, C, D, you're probably going to write bigger checks than folks that do what we do, although sometimes not necessarily. But I would tell you there's an upper limit, maybe is the way to put it. there is an upper limit to how much a VC really can be investing per round, any individual VC, that sometimes VCs violate, and I think to bad outcome, but there's sort of an upper limit. So if I go back to our example, in the seed rounds that often are, let's say, 2 to 4 million, we might invest 1 to 2 million. We would never invest, let's say if it's a $3 million round, we would never invest more than half the round. Doesn't matter what our ownership is, we would never take more than 1.5. And again, I get back to the, we want other people around the table and all the other reasons why we like that. What you see sometimes though is, and so that's dictated though, our numbers are actually dictated by the size of the fund that we are deploying, and also what we think the company can actually bear at any given point. But a VC, so there's an upper limit. I think there's but on the other side, there's some check that's too small for an entrepreneur, but you see a lot of great early firms. I mean, we started out with a small first fund, and we were writing checks in the seed round of at max 500K when we started out, right? So you could go lower, but there is some number which you really shouldn't be going higher. It starts to not work.
So on the lower side, would you say, is it like 100K or something does it make sense for you to get all wrapped up and spend time on something if it's less than a certain number?
Again, I think if you're talking about from the shoes of a VC investor, I think it really does come down to how big the fund is, right? I've seen early, like what often they call an emerging, like what we maybe still are, an emerging VC or a micro VC with a $3 million first fund, and they might be writing a check for 50K, in certain rounds. So be it, right? From the perspective of the entrepreneur, obviously their life is made easier if they can get fewer bigger checks instead of many smaller ones, but most early rounds turn into a bit of pass the hat, so they're happy to have a 50K. So as I said, I've seen VCs write very small checks when they're just starting out and they have a very small first fund and they're just trying to demonstrate that they can generate deal flow and invest in good founders and good companies.
And on that topic, how much money does a VC need to begin investing?
As I said, I think you can get away with very little. The factor weighing in the direction of having more, though, is going to come down to, like when you start your own VC firm like we did, you also are an entrepreneur. So then it comes down to also, do you have the savings, wealth, et cetera, to invest in yourself and the intestinal fortitude to take a lower salary for some number of years as you get off the ground. But you can do the simple math on this too, though, just to give any of your listeners a sense of this. And the management fee is typically 2% on capital. So if you've got a $2 million fund, what are you doing? You're doing you're making $40,000 in management fee a year, right? So it's not a lot to live on, and you probably also have other expenses too, and a whole bunch of stuff. So you start to do the math, right? Like our first fund was $10 million. That was enough to support one partner at a much reduced salary and one associate.
And you probably have some legal fees and bookkeeping fees and accounting fees and contracts.
You betcha.
And stuff.
Yep.
What are the different structures for a VC fund?
Great question. There really is. Well, I would tell you there is one overwhelming option, which is the same structure used in the broader private equity world, which is a limited partnership. So they've got a set of LPs and then a GP entity attached, the general partner that directs the decisions, and you have a management company also attached. That's set up for a variety of reasons. I don't need to go through that, or I can at some later date, but there's a lot of reasons for that. Now I would tell you, saying I would wager 95+% of VC firms are set up that way. Frankly, maybe it's 99%. There are maybe two variations on it. One has emerged recently, although it's really nothing new, which people will call sort of a rolling fund. That's actually still often set up legally like an LP, but it has different, they'll take capital over time per deal, and sometimes won't be set up as a limited partnership where they're just actually each individual deal is packaged separately as a legal matter. And then there is other variation, which you really don't see a lot in VC. I'm actually not sure I know of any pure VCs that have this structure. They may exist, though. I'd love to know who they are. I know some private equity firms have this structure, which is the evergreen fund. So it's not a from a legal perspective, it's very similar to the LPGP structure, but it's the term of the vehicle lasts in perpetuity, right? So profits don't get distributed; they can be reinvested over and over again, to the end of time, so to speak. And so that's a slightly different model. I would say it would be really cool to see some creative variation in the VC world. We actually have talked about it a bunch of times on our end. We have actually a thought for what we might evolve to over the next 5 years. And we've done some interesting stuff internally too, as to how we share equity. But there's very little, I may just not be aware of it too, but you see very little innovation in VC. You see a lot, VC actually, as I said to you before, on most stuff, VC just basically takes what private equity matured over the last 40, 50 years, the buyout guys and stuff, and just applies it to their own, when in a lot of ways it's not applicable or not right.
Some people might ask, hey, why does the business owner take venture capital money? Why not get a bank loan? Why don't people get loans?
Some do, and some do, and some of our companies that take venture capital from us do end up taking loans, and we encourage that actually for a whole bunch of different business models and categories. I mean, it's great for us as early stage investors, where you start taking on debt and being strategic about debt sooner rather than later, because it's non-dilutive for us, non-dilutive for them, non-dilutive for their employees. It's a great win. But I think what you're asking though is maybe more so like the choice between venture capital and other types of financing. I sort of interpret as more the question. And I would say to you, I actually think at the early stage, this is when, frankly, even us, like when we have gotten investment decisions wrong, and I would look more generally at the industry, when VC gets investment decisions wrong at the early stage, I actually think it's a category error. It's putting venture capital into a business that shouldn't take venture capital, right? Because venture capital is I always tell entrepreneurs, it's a scalpel, right? And it's almost a crude scalpel. It is meant for the smallest segment of businesses. It's businesses that can grow crazy, unreasonably, extremely, like you look like you're at the NASA space camp and you're under 7 Gs in your face. That's the type of growth. If your company can achieve that type of growth, you might be right for venture capital might be right for you. Like if that's possible, then venture capital might be right for you. That implies also a ton of risk, right? And so I tell all the folks too, because we're trying actually at early stage a lot of times too to try to figure out that category error. Is this a business that could use venture capital and be successful, or is it not? It's actually might be a good business, but they shouldn't be raising venture capital, right? And I always tell entrepreneurs, it's I may have these stats wrong now, I don't know, with COVID and everything else, but it's like every year in the US, there's about 500,000 to 600,000 small businesses started. And relative to our population, that's a huge number, it's awesome. Of that 500 to 600,000, every year, less than 1% raise venture capital. I'm talking capital V, capital C, venture capital. Of the less than 1% that raise venture capital every year, 99% of those companies fail. Right, so it's a scalpel where you can very easily hit an artery. And so what I say to folks too is like, now again, when you're early, debt might not be available to you, but you can still go the route of raising from individuals. Maybe you still call an angel round, but you can actually build a giant business without equity financing, or with equity financing, where you raise it from individuals and angels actually through the lifetime of what you do. I invested early in a company called Sir Kensington's, which is a ketchup company, bizarrely. And they did bring in private equity, like financial sponsors later in their life. But the early days, almost the first 5, 6 years, was all individuals and family offices. And that's great. And it wasn't a ton of equity capital. And they created a huge business and a great brand. And so you don't have to have venture capital to be a big business. But if you if you want to have a big business in a shorter amount of time, venture capital might be a thing to consider. But you have to understand also you're taking on a tremendous amount of risk.
How much equity do you think is like the right amount for founders and for key employees to hold of sort of the your archetype of a VC funded company? Where does that typically land?
Um, uh, at the highest level, I'd say more, not less, and we want that too. Um, Meaning even over the lifetime of a company, although every once in a while we even see it early stage, like you want the founder, the team to have, they should have the lion's share of the company, more, not less. I always tell entrepreneurs also, even with employees, early employees, later employees, more, not less. That would be that's my own philosophy as with respect to Blue too, and the way we share equity. But everyone makes their own call. I'll tell you, look, as you go, and there's a decent, I'd say maybe somewhat decent amount of transparency in the industry where people will report on, by stage, by role, what are sort of the ranges of equity given to different key employees and otherwise. But at the end of the day, it does come down to the founder and their philosophy on this, and also obviously the negotiations with that employee, and it's a trade-off between cash or equity. But in the early days, we just say, my comment also often to our entrepreneurs, and it's similar again to our own firm, is if you've got an employee in the early days, first couple of years, who is only going to work for you for some crazy high cash salary, they are not a good fit, right? It's just, that's a disqualifying thing right out of the gate. Or a founder too. We see this sometimes where you see a founder in the first 2 years and they want to pay themselves as CEO 200K or 250K or something crazy. Your audience may listen to that and go, oh my God, that's pittance. But like, it's like, that's crazy. That's insane. And you see that often actually, people coming out of the corporate world that did make a lot of money and they're like, holy crap, I got a life, I got kids. And so I get it. But in the early days, the founder, the team, they should be motivated by the equity and they should have more, not less.
Let's talk about your firm. So tell me a little history of Blue Collective and about your journey.
Well, I'll start with the firm. We started this almost 7 years ago. One of the other partners and I started the firm together. He and I were and are longtime friends, and also we had been colleagues. We actually met when we were both partners at McKinsey & Company. He is one of my rare friends that I want to work with in a professional setting, and I enjoy working with. I have a whole list of friends I would never do business with, even if I love them, right? So he fits in the other group. He and I he might describe this differently, but both had a professional midlife crisis, in the sense that we'd sort of done a bunch of stuff and we're thinking, what do we do next? And actually, the genesis of this was only, he called me up and said, let's do something together. Let's build a business together. I said, absolutely. So we were kind of going through what that might be, thinking about different ideas. And then his wife, one day, who's extremely successful and wiser than all of us, she said, I sort of off the cuff, but she was like, you guys have been angel investing for a while and you really like that. Why don't you do that? Again, all we had been doing was angel investing. We had never been professional investors. He and I both, between two of us, or each individually, have run businesses and started businesses and been advisors to businesses too, the consulting stuff. And I was a lawyer before that. And so we had a bit of a random walk to get where we were. And she sort of said, her comment was like, you enjoy it and it'll be hard, right? Like it's something new. And I guess I was like 35 or something at the time. And I was like, that does sound hard. And for what it's worth, I was not particularly enthused about the idea. Most of my career to that point had been working with LBO firms, small private equity firms, mid-market firms, big firms, hedge funds, et cetera, some VC firms. And while I absolutely, and I'm still very close friends with many of my the people, my clients, I sort of said, I don't know, like that doesn't seem like the industry for me. And my comment to just amongst friends here, I said, I kind of feel like all these investors are sort of assholes. And Brian, who's the guy I started this with, the way he convinced me, just for what it's worth, is he said, all right, here, because I like a challenge. He said, why don't you think about it like this? We'll do this together. It'll be fun, but what we will be doing over the next 10, 20, 30 years, we will be testing the following hypothesis. does investing turn you into an asshole, or are assholes attracted to investing? So I still remember that. That was in a weird way, kind of a funny moment. Anyhow, we got excited about it. So we built this, and about the firm, we do super, super, super early stage venture investing. So back when I was talking through the stages, we do, I'll tie it to the business stage. We do typically pre-revenue, sometimes pre-product companies. And if they got revenue, it's minimal revenue. By virtue of that, we are typically investing in what gets called the pre-seed round. Sometimes, though, it gets called the friends and family round when people look at it in hindsight. And we'll also invest in the seed round. But we like earlier. Earlier is better for us. Like 2/3 of our investments are happening at pre-seed or earlier. And when we started this too, we said, this was somewhat naively, but given our angel investing time, which I'm sure many of the people listening to this and in your network have this happen to them, which is having worked in the professional services world with lots and lots of people, young people, older people, et cetera, clients and consultants. What started to happen as you got more senior in that world is people would come to you and they'd say, hey, you get an email and say, hey, JJ, it's Joe. Remember me? I was a BA or an analyst on your team, 4 years ago. I'm starting my own business now. Would you take a look? And you would have a chat, and you half the time didn't know what the heck the industry was or business, but at that point too, they only had a pitch deck. And so you made a decision based on, it might have been a faulty memory, but your memory of that person and their competence and their grit and their resilience, all the stuff you thought mattered, and also trusting them. And so Brian and I had both been doing that, and we had been, I think, probably more lucky than not, but we've been somewhat successful doing that. So that when we started this, we just said, let's do that. Like, let's make that real. Let's try to make that systematic. And can you make it systematic? And so our model is super early stage, into great founders where we can build a conviction that they have the potential to be a great entrepreneur. And we say always a kind of a pretty good idea. It doesn't have to be a great idea, which, so all that said, it has ended up being, we've sort of realized this as we've gone, a strategy that, again, everyone hearing that might say, oh, that sounds reasonable and so on and so forth. How do you do that? So we have a whole way we do it and process now, and we get smarter at this every year. But what we've realized over the years is the way we do it is very different than the way most VCs do it. I mean, the Sebastian Mallaby book is a great thing here. A lot of that book is about how and I'm paraphrasing here, so I'm probably butchering what he says, so apologies to him. But, part of the underlying theme in that is venture capital is about finding the most outrageous ideas. Right? He has the interviews with Peter Thiel and Vinod Khosla and all these folks, and this is about, you find the craziest idea ever, and you give a bunch of capital and then a bunch of more capital, and it's either, it's a moonshot, right? It's either a grand slam or it's a total strikeout, right? Over and over again. And there is an element of that in what we do, but and again, maybe this is something I talk through more of the details, but we'll do that later now, but our model is look for phenomenal people, not phenomenal ideas. Look for phenomenal people. Because at the end of the day, you find phenomenal people building these big, giant businesses all the time that don't look crazy in any way, right? Or maybe it is, right? How they operate and all that. But that's what we're looking for. We're not looking for outlier ideas. That's the Sebastian Mallaby word, I think. We are looking for outlier people. That's the whole model.
Okay, so you're optimizing on the talent. So tell me about your framework or your approach. Is it just a gestalt, or do you have we have the 7 categories we look at? How do you think about, gauging and evaluating the talent, since that's such a critical piece of what you do?
Yeah, I'll give you three answers to that, because I would tell you the answer is not so much here's the list of ingredients, right? It's more the process that matters. I will draw a comparison to, but I'm not comparing our investment acumen at all to Warren Buffett. But it's a little bit like the discussions around Warren Buffett and other great investors like that who are consistently good. Again, we've been really good so far. We need to do that over 34 years. So I'm not making that comparison, just to be super clear. But there's always that discussion around him where it's like, no, he just gets lucky. Like he just gets lucky. You're like, really? 50 years? Yeah, it's just luck. And it's funny too, because people who say that will also say, I mean, look, he says exactly what he does. He looks at the book value. He factors in growth a little bit, but that's kind of it. He's picking value. He literally will walk you through exactly what he does. And they go, yeah, you can't do that consistently. And it's like, no. Thomas Keller could give you the recipe for whatever is his famous dish, the caviar and whatever. He'd give you the recipe for that. I promise you couldn't do it at home. So here's my quick answer. Number one is, yes, there are criteria. So there is a list of ingredients, but I would say it's not that far removed for what probably other VCs at least claim they're looking at. A certain level of intelligence, certain type of intelligence, certain level of leadership, visionary, grit, resilience, all of that. We have a few particular things we do look for also, though, which I do think sort of matter. We look for what we just call it dilution sensitivity. We want people that understand that every round of capital they raise actually reduces the size of the prize for them and their team. It's really important to us. That often is not important for other investors. So we have a couple list of things. Number two, we actually have a unique way we do it. I'll tell you how we do it, and all the former or current consultants on the line will understand this immediately. Our diligence process is primarily a series of case studies, right? Meaning what we're trying to gauge is, because we're trying to figure out potential, right? And that's really hard to figure out. So what we're trying to figure out in a interview type scenario, which is a conversation to be clear, is how they think, how they make decisions, right? How they make trade-offs, all that type of stuff. We're trying to gauge that. And so what we do is the case is their business. And as we said, we're investing early, so business isn't yet built. That's the subject of the case. So we're asking them questions about that, right? Which sometimes are forward-looking. Hey, I know you're not launched yet, but how are you thinking about pricing? If their answer is, don't know, that's a bad answer. If their answer is, it's here is the pricing, and then you say, but what about these other models? And they go, no, I'm not doing that. That's not a good answer. It's very similar to the case studies we probably all went through to get a job at whatever firm we worked at or work at now. And then our third bit is it comes through discussion, right? So we have like probably many of the firms you all work at or used to work at, it is a flat structure at Blue. This is part of the fundamental values of who we are. We crib very liberally from the McKinsey values. Obligation to dissent, which we translate as everyone has a voice. Not everyone has a decision, but we don't make a decision unless everyone has a voice. And so what you do by virtue of that is you're getting everyone's read, right? And we're getting everyone's read on that person, right? So, we're talking through their commercial acumen, and you're getting every one person's point of view. Well, I'm not sure it's that great. Well, why do you say that? Well, because, he told us that story about that time, and he did this, and then, well, I think it's actually pretty good. Here's why. I saw this. I observed this. So that's how we do it. Like, it doesn't always work. We're like any other VC. We got a lot that go to zero, but where it works really well. And it allows us to find people early who build these gigantic businesses, and people also that tend to get passed over by every other investor. And we love that. Yeah. Oh, that's the not short answer, but that's the best answer I can give you in a short amount of time.
And how are people getting into your funnel? Are you, relying on your network to refer people to you? Are people just coming in cold on your website and, asking for money? Or do you have run contests? Or how are you getting the discussions with the folks?
It is the first two. It's mostly the first two things you said. So I'd say it's our network, which is constantly under construction, right? So we live and die by the network that we've got. We live and die by whether or not that can keep growing. So at the same time, too, there's a lot I had to de-learn from the McKinsey days and consulting days and even operating days and even the lawyer days, all that, in order to start to understand what it meant to be an investor. One asset, though, from the McKinsey days, giant network, just a bunch of friends all around the world, different industries, fantastic. That was a huge help, but you can't get lazy on that, or you can't take that for granted. And so it's even how we have to train our associates too. You've got to be continually building that, because a lot of our model too is finding people before they even know they're going to be an entrepreneur. And those are the best, where it's, met you 6 months ago at some event. Through a variety of things, I'm starting my own thing. Wanted to reach out. You guys seem friendly and thought you had good perspective, et cetera. So it's network. As we've gone on 7 years in, it is also brand in the sense of like we get more cold emails than we can handle at this point. All referrals. We get emails from people that we passed on ages ago too, saying, I know you passed on the first one. Here's the second, or you passed on me, but I like the chat. Here's this other entrepreneur I'm friends with. Would you mind talking with them? And our model is always be accessible, so we always have a conversation. We certainly only invest in less than 1% of the companies, but we try to be helpful if we can. And I tell you though, what we don't do is some of this where you were going towards the end, and maybe we should. I actually think this is probably our failing. We are really bad. I'll put it this way. Will, you are my first podcast ever. I don't do podcasts. I don't think I'm very good at podcasts, but I don't do these in the VC world, though. This is par for the course. People are doing podcasts. They're doing video interviews. They're doing the Twitter feed is off. They're spending all day on Twitter. You see new comments from big VCs about how sourcing is 99% Twitter. We barely touch it. I mean, we've actually debated as a firm many times that we just say we're not going to touch it at all, and we try, start, and stop. So we don't really get much deal flow at all through that. We are we invest in off the radar entrepreneurs, and we also have stayed off the radar. As I said, I think that's probably a failing. The longer we do this, and we really should get our name out there, but we've struggled with that. We're not good at it, and we struggle to figure out how to do that in accordance with our own, values and principles.
How do you it sounds like you've built quite a large network. I'm curious, kind of mechanically how you deal with that. Do you have a CRM system? Do you have an approach where like your higher value contacts, you try to touch base with them every, twice a year, reach out to them, give them a call, something? How do you kind of manage that network of relationships that you've built up?
Yeah, as a firm, we don't do anything systematically, meaning at the entity level, and we've talked about that in the past, and maybe over time we do start to do that. At the individual level, but there is an expectation that we are each doing that however we see fit. And I tell you, different people on the team have different strategies for this in terms of how they do it, and some people are list driven and this and that. But the outcome is probably the same, which is about what you're saying, which is there's sort of high priority folks you're touching base with frequently, others maybe less frequently, et cetera, so on and so forth. So everyone's sort of doing that. That's an expectation if you're on the team too. I would tell you the underlying philosophy though, which again, I know this may sound sort of like touchy-feely or something, is you got to become friends with people. So I try not to even use the word networking on like internally, because it just feels so artificial to me. It's just making friends, right? And building relationships. And if you get to know people and actually know them and who they are, what makes them tick, how many kids they got, are they married, are they divorced, all that sort of stuff, it's a lot easier to do who's my high priority folks versus not. And that'll be a merge also of sort of personal and professional, which tends to be the most valuable. So anyway, I don't have a great life hack tip for you guys there. As I said, some people on the team are very list driven, others not. And LinkedIn, personal CRMs, but me personally, it's a bit more free flow for me, and I sort of know who I need to. Then the reason I bring up the friend point is I think about his friends. It's like, oh my God, I haven't caught up with Jeremy in a while, right? I wonder what's going on in his life. And it turns out Jeremy also refers to deals and this and that. But it's for me, I try to make it so that the motivator is I like this person, I want to spend time with him.
Talk to me about the profile of some of the founders you've invested in. Are these people who are coming out of grad school and had some idea, or consultants or bankers or corporate people, or very young people? Like what are some of the maybe there's just a wide, very heterogeneous group, but give me some examples of what are the different profiles.
I'll give you some examples. I would say it is extremely varied. It's extremely heterogeneous, and that's a good thing because it, as best it can, it's a decent marker to us that we are evaluating things on their merits as opposed to other criteria. I would so give you some examples, right? We've got a guy who was a C-suite executive at a might be a Fortune 100 company, giant company. Been doing that for nearly 30 years. So a bit older too, but always had an entrepreneurial streak, and built something at one of his companies, or built an early sort of version of something at one of his companies, and said, this actually has applicability beyond, and was able to spin out, obviously with their permission, everything else, and teamed up with a younger guy, but the two of them, one was actually a consultant. So Gary is the fellow I'm talking about, and Bossum was a consultant, Gary was his client. They spun out and created this company called Uncorp, and it's a massive company now, doing hundreds of millions of revenue, and not some crazy silly valuation, but I think deserved, and growing crazy too. And it's a no-code enterprise app development platform. And I mentioned him; they've had success. So maybe the profile there is sort of the older, former, successful corporate person profile. In early stage VC, I would tell you that profile is persona non grata, right? Like that is, if anyone listening has tried to do a startup when you get older, it is harder for a bunch of personal reasons too, but it's hard to do in VC if you're not given time of day. In fact, for the first few years of that company's existence, Gary had, when you walked into Uncork's offices, on the wall, you saw the logo, that's standard startup architecture. And then around it though, floor to ceiling, he had on there all these verbatim quotes. And when you got closer, you would read them. It was all of the no's that they got in the early days fundraising. And the one front and center, I won't name the VC firm, but it's one of the ones everyone would be familiar with, from their managing partner. It said, "You're too old." Anyway, that's one profile. We got a bunch of young people too. We've got, or younger people maybe. We've got these two ladies running a company called Lemonada. It's a podcast company, so they make content, and they started only 2.5, 3 years ago. One of the ladies is her name is Jess. Her background was at TFA for a really long time. And she's, through a random set of events, got involved as the executive producer of Pod Save America at some point in her life. And then she teamed up with a friend of hers who is a creative, right? Like a playwright and artist, et cetera, and has run a nonprofit for a bunch of years, an arts nonprofit. They teamed up, they create content, they got this great business, and the economics are fantastic, and they're growing super fast. And that also, that was when she went out to raise the initial round, no one took her seriously, right? What does someone who did TFA know about anything? We're like, so we love that. So they're great. I would tell you, and we've got really young folks just coming out of undergrad. We've got a company called Green Project Technologies. The guy worked at Goldman for 1 year. He's got more energy than anyone, and he's building a platform for SMB carbon emission monitoring, and then broader sort of sustainability metrics specifically for SMBs. And so he's a little bit more the classic young person, frenetic energy, et cetera. Although at the same time, I'd say at the early stage, you're coming out of a professional services firm. Tends to be the case. Early stage VCs say, "Oh, I don't know, Goldman. Like, what do you know about anything?" But anyhow, so it's a broad range. I'd tell you, just as a final funny comment, we have in our whenever we raise a fund, we have in our prospectus a page that says, here's the diversity of the portfolio. We define that more broadly than just color your skin or who you're sleeping with or this and that. That's on there too, but like it's broad. We got parents, and we got people over the age of 50 and this and that. And we've had that in there forever, and it speaks to the heterogeneity of the founders. And we've got like 40% female founders and all this sort of like. And I had this funny conversation a few years back. We were raising our second fund, and it was a good conversation. I chat with the guy for about 2 hours, and then he's looking at that page. He said, "Man, you really didn't focus on this very much." I said, "Well, yeah, look, it's part of our model. We're again looking for people with great talent and skills and potential." And he said, "Well, this is amazing though. The DEI metrics are really off the charts, and that's amazing." And he said, "What do you do to optimize for this?" I had never been asked that question before. And I sort of paused and then I said, we don't do anything. We really don't. We don't do anything. And I thought, oh, maybe we should, but we don't. And we get these great, outcomes anyhow, at least from that dimension. And I said, look, if we didn't have a portfolio where the founder profiles were varied, we would probably be worried we got a shit portfolio, and we'd be scratching our heads going, what the hell's wrong with our own network and our own point of view, that we're zeroed in on whatever people that used to play lacrosse at DePaul or something like that. What are we doing, right? So, but as I said, that's not something we're optimizing for. But what ends up happening is when you're looking for founders out in the world that are overlooked and undervalued by other investors, by virtue of that, you're going to end up with a very diverse portfolio, or a very diverse set of founder backgrounds and profiles. And rightfully so. And we hope there's a commonality around skill sets and potential.
So JJ, if there's any overlooked and undervalued founders out there, or someone who knows someone who's potentially an overlooked and undervalued investor, how would people get in touch with you, or where would you point them online, your website or any other contact
Just email
information?
me. Email anyone to the company.
All right.
Email us.
You want to give a website, or how should people find you?
Yeah, www.bluecollective.com. You can email me at jjcasper, that's Kasper. It's like the ghost, but with a K, at bluecollective.com. You can email anyone on the team, though. The email addresses are on the site. And if they don't get back to you, it's probably because they're overloaded. And if they really don't get back to you, let me know, because it's as I said, it's the expectation on the team that people get back to you. That's what we try to do. We don't always succeed, but that's the aspiration and the goal internally, is to actually be accessible to early stage entrepreneurs. It's a tough game starting a business. We can't answer all your questions, but we hope we can at least be a good, person to listen.
And we will include those links in the show notes. JJ, you have been a fantastic guest, and I am so proud that this was your first podcast interview.
Yeah.
Your podcast virginity is now.
I've gotten unleashed on the Unleashed podcast. That's what's happening here. See if I make this into a trend.
That's right. So that was fantastic. I learned a ton, and it was fun hearing about your business, and it was very generous of you to do the primer section and educate me. It was great chatting. And listeners, if you would be so inclined to give this show a 5-star review on iTunes, it does help others discover the show, and it makes me feel good. And you can also go to umbrex.com/unleashed and sign up to get an email about the show. JJ, it's been great speaking with you again, and good catching up.
Yeah, thank you. Well, it was very good, and I enjoyed the questions, and this was well done. So thank you very much.